All right, today I want to talk to you about an important tax change coming to retirement savings that will affect many high earning federal employees starting January 1st, 2026. The IRS rules requiring certain catch up contributions to be made on a Roth basis rather than traditional pre tax. And this is the first time in history the tax code has mandated Roth savings. So the background here is this provision was part of the Secure Act 2.0 passed back in December 2022. It was originally supposed to start in 2024, but the IRS delayed it to give implementation time for employers and administrators. And now on September 15th, 2025, just recently, the IRS issued final regulation confirming January 1st, 2026 effective date. You might be wondering, why is Congress forcing high earners into Roth contributions in the first place? And the reason is primarily about tax revenue. With traditional pre-tax contributions, the government has to wait decades to collect taxes until you retire and start withdrawing that money via perhaps regular withdrawals or required minimum distributions. With mandatory Roth conversions, the government gets its tax revenue immediately through after-tax payroll deductions. So instead of waiting, 10, 20, 30 years for you to retire and pay the taxes, they're collecting the taxes now. So this just helps Congress with budget projections and generates revenue in the near term rather than many years from now. So it's a revenue accelerator for the federal government, packaged as retirement savings provision, essentially. So the underlying motivation is about when tax dollars flow through to the Treasury. Okay, enough about that. Who is affected by this? So who does this apply to? The rule affects employees who meet two criteria. One, first, you must be eligible to make catch-up contributions in the first place. So this means that you're age 50 or older, turning age 50 in 2026 or older. This includes both regular catch-up contributions, which are $7,500 in 2025, and the new super catch-up contributions of $11,250 for those aged between 60 and 63. So second, this is a key threshold. Your FICA wages from your employer in the previous year must exceed a certain amount. For reference, if this rule has been in effect in 2025, the threshold would have been $145,000 in 2024 FICA wages. In 2026, they're going to announce that new threshold. So now an important note about married couples. This threshold is based solely on your individual FICA wages from your employer, not your household income like many other things are. So your spouse's earnings are separate. So even if your spouse earns significantly more, theirs isn't included in this calculation. This means married couples need to evaluate this rule separately for each spouse who's making catch-up contributions. So here's what changes. If you meet this criteria, your catch-up contributions must go into a Roth account. That means they'll come out of your after-tax paycheck. You will not get the upfront tax deduction you used to get with your traditional contribution. And that actually is noticeable. So for federal employees using the Thrift Savings Plan, this is mandatory. So the private sector workers, there's an interesting twist. If it's your 401k, 403b, or 457 plan that doesn't offer a Roth 2, you won't be allowed to make up contributions starting in 2026. This should incentivize more companies to add Roth options to their plan, hopefully. Now, what many of you are thinking is, why would I want to pay taxes now during my highest earning years instead of in retirement when I might be in a lower tax bracket? It's a fair question. Honestly, if this feels counterintuitive to many people, then you're not off base. Many do feel that way. In fact, studies have shown while 96% of participants in Vanguard's managed plans have access to Roth, only 18% actually use it. So a very small percentage. However, there are some benefits you want to consider. First is tax-free compounded growth. Once that money is inside of your Roth account, all future earnings are growth tax-free. Huge. So when you withdraw it after age 59 and a half, you pay zero in federal and state taxes on both contributions and earnings. That's a very big deal, and there's not too many areas where you can get that tax-free growth. Secondly, this reduces your required minimum distributions in retirement. So since 2024, Roth TSP accounts are no longer included in RMD calculations. Lower RMD, taxable income in retirement, which may help you avoid things like Medicare premium surcharges or just keep you in a lower tax bracket. So here's some planning considerations. So there's a lot of planning opportunities for new employees. Here's one of them. Since your wage limit looks back to the previous year with the same employer, right? New hires might be able to get 1 or 2 free past years from mandatory Roth contributions because there is no history of higher earnings with that employer. For married couples, this creates some interesting planning scenarios. If your spouse is just above the threshold and the other is just below it, you might have different contribution strategies for each person. And this does happen from time to time. So you could also consider household cash flow implications. So if both spouses shift to Roth contributions, your combined take-home pay could decrease noticeably right up front. So make sure your budget can absorb this type of a change in cash flow, especially if both of you are affected. So here's the bottom line. If you're a higher income earner making catch-up contributions, you need to prepare for this change. Review your contribution strategy now before the end of the year, understanding how this will affect your take-home pay in 2026, and consider whether you want to adjust your overall savings rate or strategy. So for federal employees, the TSP will automatically comply with these rules. So you don't really have to do anything if you're doing the catch-up. For private sector, it's separate. Check with your HR department and you can confirm whether your plan will offer the Roth option. So this is a significant shift in retirement planning for federal employees. And while it may feel like a tax increase now, the long-term tax-free growth could be a valuable component to your overall financial plan, depending on your circumstances. As always, consult with your financial and tax professionals to determine the best strategy for your situation. To stay up to speed on changes to your federal benefits and retirement strategies, please like and subscribe and follow us on YouTube. Thanks so much. Bye-bye.